We're half an hour from the open in Hong Kong, Shenzhen and Shanghai. You're watching The China Show. I'm Rebecca Choong Wilkins with David Ingles.
Let's get to your top stories today. Investors set to get a fuller picture of the Chinese economy after stimulus measures were unleashed. The GDP print is coming through and other economic data due in the next hour.
And TikTok looks set for a reprieve from a US ban thanks to a holiday weekend and the incoming Trump administration's pledge to extend a divestiture deadline.
And Chinese developer Vanke reportedly facing this takeover by state authorities with its CEO taken away by police. Good morning. Happy Friday morning from the Asia Pacific. Welcome to the show. Lots to get through when you take a look at these markets. I think on a macro basis, it was really one of the very few weeks in the last 2 or 3 months where we've had the dollar not really on the way up. It did gain, though, the dollar against some of its peers. But broadly speaking, we are on track for either a flat or even softer U.S. dollar. That did provide some runway for equities while you are seeing declines still. With a full trading day left, of course, is a caveat. They're still set for a weekly gain. We're watching a lot of large caps in the region. We'll get to TSMC in a moment. That, I believe, is up about 2%. Oh, thank you so much. We're up on 1.4%. Earnings came out right at the closing bell in Taiwan. The capex and the outlook and the guidance, they're beating estimates. Up, in fact, substantially in the U.S. session. Unsurprising, we're getting that follow through today. Rio Tinto, based on reports, could be looking at this. Do we call it a merger? Maybe a potential merger. Well, it's a potential deal still in the mix there. With Glencore, we're down. We're coming off lows of the day, though. And, of course, Nintendo is off 6.3%. Switch to April 2. Mark your calendars. Now, very quickly, the approach to the open today, it's going to be very busy in Chinese markets. We have a flurry of data with housing prices set to come out at about the open today. We're lower on futures, as you can see on your screens. We're still tracking, by the way, this sort of different story, but related story, of course, this rally we're seeing in metals prices. Anything from iron ore, for example, aluminum also had a substantial week this week. So at these levels, we're about the highest since about early or mid-December. Will the data, is a question here, Rebecca, will the data underscore and support this move up that we've seen in cyclicals like metals prices, Rebecca?
Right, that's it, David. I mean, today, epic day for Chinese data. A lot of people waiting for this, not just sort of quarter-to-quarter, but really for this annual number, the comparison that we're going to be able to see, big questions that need to be answered from this data. Are we seeing stimulus finally taking effect? Are we seeing any signs that we are breaking the deflationary cycle? And as you say, Dave, we'll see those December home prices, potentially signs of a green shoot or a bottoming out. We'll have Helen Qiao joining us. We'll be able to ask her and pick her brains on that. And then just a couple of elements here, I think, to pick out when it comes to markets. The HSI, we saw it flirting with that 100-day moving average yesterday, looking to see whether we actually get there, and we close there today. And a little bit of a flashback from my prior life covering credit here. My WeChat groups, WhatsApp groups, really alive with discussion on Chinese property developer Vanke, the CEO reportedly taken away by police by local media. There's been some contradictory reports on precisely what's happening with him. We also have reports of this task force sent by the local government in Shenzhen. It's a really important builder here and an amazing reversal of a story. Last year we thought Vanke was going to be one of the big guys that survived this, looking very, very different. Yeah, huge day, Dave. And we're also looking at these repo rates climb to their highest level since March 2023.
Despite some of the injections we've seen from the PBOC of late, which I guess underscores the other story that we might get, and I have to underscore that's the operative word here,
right.
A potential triple R cut, which, to be frank, has been well flagged, but also much expected as far as when that actually comes. We were expecting that triple R cut to come in December. The PBOC governor himself, I believe, also signaled almost as much as that. And the expectation is, and Helen Qiao, that Rebecca just mentioned, joins us later on, does expect that to come perhaps before we enter the Lunar New Year. And to underscore that, funding costs, as you can see on your screens, are the highest since 2023. Right, okay. So more on the China story, we are looking, and we are set to get, of course, some key economic data in the next hour or so. You have fourth quarter GDP numbers. Let's bring in Stephen Engel, our Chief North Asia correspondent. He joins us out of Shanghai today. Steve, give us a preview.
Yeah, I mean, we knew 2024 was a tough slog, of course, for the Chinese economy. That got a little bit of a momentum boost in late September with the first round of stimulus, but we've kind of hit a lull in promise fatigue and, of course, no specifics on big fiscal stimulus, which we might get, though, coming up in the National People's Congress in March. But again, it's a couple of months away. And right now, the consensus estimate for full year GDP growth is for 4.9% in 2024. That's given we could see 5% GDP growth in the fourth quarter. So that's a pickup from the third quarter of 4.6%. So things are starting to either bottom out or at least pick up a little bit on sentiment as we go into the new year. But there's so much uncertainty, obviously, with the consumption trends still very weak, with retail sales having, low single-digit growth for the first, or actually every month in 2024. 15 out of the last 16 months has been single-digit retail sales growth. And of course, CPI just eked out a 0.1% gain in December. PPI, factory gate deflation, has been in deflationary territory for 27 consecutive months. That's why we need to sort of look at the GDP deflator gauge, and the survey of economists by Bloomberg expect that this year to fall to 0.2%, minus 0.2%. The decade before the pandemic, it was positive 3.4%. So we really see that deflation is sort of entrenched. That's why everyone's looking forward to the NPC in March. Also, the Lunar New Year holiday, which begins in a couple of weeks here, the largest human migration on the planet expected to begin. Will people start spending? Yesterday, I had an exclusive interview with the IHG CEO, that is Eli Malouf. He's here in town right now. He says there's some hopeful signs on travel and travel spending.
Travel continues to expand. The middle class continues to expand. People love to travel for profit and for pleasure across the country. And that continues. So look, we know that there are some sectors of the economy that are not doing as well as in many economies. Like, not every sector is always doing well. China's a $20 trillion economy. So in a $20 trillion highly diversified economy, you're going to find some sectors that aren't doing well. And in China today, we know residential real estate isn't doing well, but experiences are doing well and travel is growing.
You can pretty much bet that there will be a blip upwards in retail sales in the late January, early February during the Lunar New Year holiday. But again, will it be an anomaly, or will it basically show some momentum throughout the rest of the year? We simply don't know yet right now. We're going to get retail sales numbers coming out for December, likely to be at 3.6 is the consensus. Bloomberg Economics, though, says 2.8%, which would be a dip from November.
Steve, I mean, thinking about, as you're saying, this momentum and whether or not we can see that sustained, a big potential headwind here is going to be, of course, the incoming Trump administration. We had these Senate confirmation hearings with Trump's pick, Scott Bessent, overnight. He had some quite strong remarks when it came to China. Let's take a listen.
They are attempting to export their way out of that as opposed to doing the much-needed internal rebalance. Yep. So, I am with you on the need to open markets, but we cannot allow a player like this to flood our markets or to flood the world.
Steve, just give us a little snapshot of some of those key remarks that Bessent made on China, and also a bit of context on to what extent this is a bit of a surprise. There had been a little bit of optimism that Trump's lineup, we had Bessent as Treasury, Perdue as ambassador, of course, Elon Musk, who has, well-known business interests in China. There had been some hope that that lineup might mean a more pragmatic approach to China policy. Is this a surprise to see Bessent so hawkish?
Well, it's interesting for sure. And we thought that, the Treasury Secretary, the incoming one, would strike a more pragmatic tone. We simply don't know yet. And that's why Garfield Reynolds earlier this morning talked about the fog of uncertainty. And that's something I've definitely felt here at the UBS Greater China Conference. There's a lull right now in spending and in confidence because we simply don't know what stimulus is going to come from China and also what policies on day one and forward from the Trump administration. Those threats of tariffs obviously will be a headwind for China. And, right now there is perhaps some would say overcapacity, overproduction on the industrial front. That's why those industrial production numbers we'll get later today are likely to stay very steady. But then there's that weak demand, obviously. So if those tariffs come on, where are they going to find? Where are exporters going to find their customers in a domestic economy where confidence is weak and deflation is entrenched? So that is that yawning gap of imbalances that Bessent was talking about. We'll have to see what policy is going to come forward. He's in the confirmation hearings right now. He will perhaps strike a more hawkish tone and compare it against the previous administration. But going forward, he essentially says the most imbalanced economy in the history of the world. That's what Bessent said of China. They are in severe recession, if not depression, trying to export its way out of its problems. So let's see how this relationship goes forward.
Steve, thank you so much. Stephen Engel, our Chief North Asia correspondent there in Shanghai for us. Really a reminder of the other top story we're tracking today. Property prices are due in 20 minutes' time. And, of course, within that space, the real estate sector, China, Vanke, is indicated sharply lower, give or take about 3% here, as we approach the pre-market in 9 minutes' time. And, of course, the story we were just talking about there, based on some of these reports and conflicting reports here, that maybe the CEO had been taken into custody. More on that, Rebecca, of course, later on the show.
Yeah, absolutely. I mean, I'm thinking a little bit more again about this US-China story, this potential collision between the incoming President Donald Trump and Chinese firms. We're looking at the fate of social media app TikTok. It could be an early test of how relations will look over the next 4 years. Let's bring in our tech reporter, Annabelle Jewelers, for the very latest. Annabelle, it looks now like the fate of TikTok is in Trump's hands.
Yeah, that's certainly what it seems to be. I mean, of course, we've got the deadline. It's January 19 when they were supposed to have found a buyer, or otherwise the app would have been shut down. So, of course, that's just a couple of days away and just ahead of the inauguration as well. But how we're sort of thinking about this now is that maybe President Trump's teams could take advantage of sort of like a clause in this contract, which basically means that ByteDance could be granted an extension of 90 days if they do manage to find a buyer, or if some sort of serious negotiation is underway. In terms of the actual potential bidders, I mean, we've been reporting this week that Elon Musk was one of those, the Chinese government, that was alongside their thinking, or within their thinking possibly. According to sources, there's billionaires Frank McCourt, Kevin O'Leary. They've been talking about their so-called Project Liberty, about TikTok 2.0. But certainly we do know that the Trump team and President Trump himself has had kind of a change of heart on this app, and even though he once wanted to ban it, there's now his incoming national security advisor, that's Michael Waltz, who was on Fox and Friends, but essentially saying they're going to find a way to keep TikTok going, and they're not going to be letting the app go dark come Sunday.
Might the Supreme Court have something to say? They're set to talk about this again today.
So they're going to be issuing an opinion. That's what we had in the announcement on the Supreme Court's website on Thursday. That's going to come at 10 a.m. Washington time on Friday. Now, the court doesn't actually say in advance which opinions it's going to be issuing on particular days, but in this case, it's likely it could be in relation to TikTok, especially because they've been handling it on an expedited basis, the case, and that also, of course, provides some level of clarity before Sunday, when we really don't know what happens next.
In the meantime, we have seen this sort of pretty extraordinary migration of so-called TikTok refugees to other Chinese apps, one of them being Xiaohongshu. It's a really interesting commentary in the People's Daily today, talking about this as a form of online ping-pong diplomacy. Just tell us what we're seeing.
Yeah, the ping-pong diplomacy is interesting because, you know, it's the question of how long is this sort of allowed to continue on for, because some of the exchanges seem to have been relatively frank, and would that come up against censorship not only from the Chinese side? Maybe these are their exchanges the US might not want to perhaps see either, but certainly there is a lot of people that are talking on this. And when you take a look at the download charts, earlier this week we were talking about what we were seeing on the Apple iPhone download charts, and Xiaohongshu, and also Lemonade, that's owned by ByteDance, who are number 1 and number 2. Now we've got the Android figures that have come out as well, and you can see these here. It's actually a very good moment for Xiaohongshu, because we're hearing that some of the bigger shareholders of the company are looking to sell their stake, or a stake in the business that would value it at $20 billion. That takes its valuation back to 2021 levels. So very good moment to be having those kinds of negotiations. But it's not just these ones as well. I mean, if you take a look at the last close of Duolingo, for instance, overnight, and given that people need to figure their way out around these apps as well, particularly Xiaohongshu, they're actually turning to learning Chinese, Mandarin, and they're saying that they're seeing a lot more users, a huge increase in people turning to the app as well. So Duolingo, another unintended beneficiary out of all of this.
There we go. It's hard to game scenarios out. It's
this one's been tricky.
difficult for policymakers there. Belle, thank you so much. Annabelle Julius, our tech reporter.
Yeah, and still today on the China show, the future of China Vanke is in question after reports of a local government intervention and the detention of its top executive. We'll have all the details about that coming up next. And we are counting down to a very exciting open of trade in Shanghai, Shenzhen and Hong Kong. This is the China show.
Welcome back. A Chinese media report says developer China Vanke may be taken over by state authorities. That's after its top executive was reportedly taken away by police. Let's get the details now, which are very confusing at this point, to be honest. Our China correspondent Min Lo is here with us to take it. What do we know exactly here?
We don't know a lot. There's a bit of mystery here over the whereabouts of the CEO because we had local media, Economic Observer, reporting that the CEO was taken away by police. Of course, our phone calls to him, Bloomberg's calls to him had gone unanswered. But hours after the first report came out, another local media reported that they managed to get a call in to the CEO. They didn't reveal the contents of their discussion, but the CEO was seen still promoting his company's rental apartment business on social media on Friday after reports of him being taken away were reported. So not quite clear what's going on there, but what's clear from local media reporting is that it looks like the Shenzhen government has sent a task force to come to take over the reins of the company. Vanke, of course, is headquartered in Shenzhen, and this comes as we had seen a steep sell-off in bonds, trading for its 3.9% Yuan bond that expired in 2028, had halted trading twice yesterday after prices fell by 20% and 30% respectively. And this is a company that is facing huge amounts of debt this year, about $4.9 billion that are maturing this year. That is the largest amount for any Chinese developers, according to Bloomberg calculations.
And it's quite a dramatic reversal. You know, I really remember last year we talked a lot about how Vanke might be one of the lone survivors, in part because it had a different business model from a lot of other developers. That model has now really fallen out of favour. Markets are pricing in a potential default here. Talk us through some of those risks and whether or not a state intervention actually does mean that we can avoid a restructuring, that we can avoid a large-scale default scenario.
Yeah, as you said, it's really a dramatic reversal because up until 2023, it was always consistently one of the top three developers in terms of contracted sales. So what this government step-in means for the company, there's a lot of question over whether this means a government bailout, but our Bloomberg intelligence analyst Christy Hung is saying that's not the playbook of the government. They wouldn't want to throw good money after bad and set a precedent for rescuing or bailing out developers. What could possibly happen is a sort of management shakeout and, again, prioritizing of property owners, possibly at the expense of bondholders, because the priority now could be to get those 200 billion yuan worth of homes that have been sold but not yet delivered, to get those completed. Again, as I said, the government step-in could probably break that negative feedback loop between weak liquidity and weak sales, because if you look at Vanke's contracted sales over the last year, every single month we have seen double-digit decline, 35% decline overall in 2024. It's been making losses since the last quarter of 2023. So at least the government step-in could maybe inject a little bit of confidence and increase creditors' prospect for recovery.
Bloomberg's China correspondent Min Lo, and we'll be following the very latest on Vanke very, very closely. This big question of moral hazard, a big question of what a bailout might mean. And elsewhere, other headlines coming out of China this morning. Bloomberg's been told that US Treasury Secretary Janet Yellen's computer was infiltrated in a breach blamed on Chinese state-sponsored hackers. Now, sources say unclassified files were accessed as part of a previously disclosed cyber attack on the Treasury. We're told the attackers appear to focus on the department's role in sanctions and intelligence, but didn't penetrate email or classified systems. China's Vice President Han Zheng will be at President-elect Donald Trump's inauguration on Monday. In a statement, the Foreign Ministry confirmed the visit, saying Beijing is willing to step up dialogue with the new administration and wants a stable, healthy and sustainable relationship. Trump has reportedly extended an unprecedented invitation to President Xi Jinping. And Zhejiang Mining has agreed to pay $1.9 billion for a 24.8% stake in lithium and potash producer Vanke Mining. Zhejiang has grown aggressively in the last decade, mainly through a string of acquisitions. The deal will give it the right to recommend 5 directors to Vanke's new 9-member board.
Yeah, and we are looking at, of course, a lot of those stocks. Zhejiang is about flat. Vanke is traded over in Shenzhen, so we should get pricing on that in a couple of minutes or so. Counting down to the open of trade, and also the release of December home prices coming through at the open 7 minutes away. You're watching The China Show. Welcome back. Happy Friday. 5 minutes away from the opening bell. So pre-market shows you the stock to watch today is this company on your screens. Some conflicting reports. What we do understand, what we do know, is that we do not know where the CEO is. We're down 9%, and this really is against the backdrop of still a very weak housing market, of which we will be getting another reminder of that, Rebecca, later on. But yeah, what do you think of what's going on
numbers
here?
Coming through on property, but I think this Vanke story is just really fascinating. It's such a reversal. Last year, it was one of these names that we really thought was going to be a survivor, that it was actually one of the rare top 3, as our former, as our China correspondent just highlighted. You know, it's been such a sort of stable name, relatively speaking. So to see this, particularly with the authorities potentially involved, this has actually been very rare. We've seen it with Evergrande, but not really with any other big major Chinese developers.
Not yet. And you know, suffice to say, this is a developing story, and hopefully we get more clarity on this. Markets are voting with their feet currently. We're down 9% in the pre-markets. Plenty more ahead, including the open. This is Bloomberg.
Welcome back. You're watching The China Show. We're counting down to the open of markets today. It's going to be a very, very busy market. We expect data to be coming through, the GDP data, as well as, of course, we have these property numbers expected any moment now. Dave, really the market is hoping to see some signs of green shoots coming through.
Yeah, especially in the more high-frequency numbers, like, I guess, some of the property numbers, because we get various data points on just home prices themselves, right? Whether that's home sales from the developers or the actual prices themselves. And I think we were talking about this before the show started. You know, there were early signs that things were picking up relatively.
Right, yeah. So CRIC data showed that in October, we did have finally the first signs of positive numbers coming in. That then switched back to negative through the rest of this year. But let's see, might be signs of a bottoming out.
Yes, to Rebecca's point, right? You really want to look at these numbers almost on a sequential basis to get a sense of momentum. We're still waiting for the home price numbers to come out. They should be out any time now. As we wait for that, though, declines at about the open here, 0.3 to 1%. Similar losses, almost moving in tandem there in cadence as far as the benchmarks go. The Hong Kong market's looking like this. Broadly speaking, though, global stocks are on track still at this point, with almost a full trading left, to eke out a weekly gain, and the dollar still on track to eke out a weekly loss against most of its peers, although that's a relative term. Of course, it's been really about dollar strength the last 2-3 months or so. Hang Seng Index, as Rebecca was pointing out here, we this week did see a bounce off the 200-day moving average into about the 100-day, which is the, I guess, the next resistance level if we close above that. Okay, here we go. December new home prices are out and barely down. Still down.
Still down for 19 straight months, but very, very gentle. The prior decline, that month before, was 0.2%. So this is certainly looking like a moderation. We have, again, declining prices at a slower pace of declines. To our point about potentially seeing some kind of bottoming out in this market.
Yeah, call it zero, which is a good thing as far as that goes. We're certainly not out of the woods as far as this conversation goes here. In fact, just on this very number, we'll get more on this later on. And of course, at the top of the next hour or two, we included in the series of numbers coming through out of the National Bureau of Statistics will be, of course, investments going through into the property sector, which is really, I guess, in many ways, a forward-looking indicator for the industry here. Okay, speaking of property, there is one specific stock, A&H shares listed in Shenzhen and here in Hong Kong. The Hong Kong listing of China Vanke is down about 9% last we checked. Do we have that? Should be coming up on your screen shortly. There we go. Thank you so much. We're off lows of the day. It's still down about 5%. We don't know where the CEO is, suffice to say. Zijin Mining, in a deal here with the company that's about to come up bottom of your screens, it's about 10% up. It's taking a stake in Zhangguo, which is really a potash miner, but it's a lithium play. It has a little bit of that as well. And Long E Green, surprisingly in the green, following guidance which effectively said the company is still in the red. Okay, live TV, there we go. We're down a little bit right now in your early minutes of the, what day is it? Friday.
Data dump day, David. How could you forget?
How can I forget? Marvin Chen is here to remind us really of where we are in this market story. Out of Bloomberg Intelligence, of course, our equity strategist. So we have economic numbers coming through. Should it be any surprise that the economy is still not on solid footing? How do you think this impacts sentiment?
Yeah, I don't think we're going to see much surprise at the GDP level. We're probably going to see around 5% growth, but the devil's always in the details, right? So I think markets are more focused now on the retail sales number and the property sales numbers that you just mentioned, and it's more about the sequential pace. But more broadly, I think there's uncertainty whether we are actually seeing a recovery, and I think it doesn't help that we're kind of entering this Lunar New Year fog period. So we think sentiment could be kind of weak until March or April, and that's when we get the annual MPC, we get the macro indicators as well as corporate earnings, and hopefully we also get some more clarity on the U.S. Tariff policies.
Thinking about U.S. tariff policies, we are days away now from the Trump administration. We're getting trickles here and there, comments from Scott Bessent and the likes on their China policy. What are you expecting? Where are we going to see the biggest impacts for China stocks?
Yeah, I mean, now is when we're going to see if the threats become reality. And I think with a lot of the noise, it's really, no one really knows what to expect. But we do think that some of the fears of tariffs are overblown for China. If we look at, there's definitely going to be an impact on the economics. But for the listed universe, we look at MSCI China, international revenue exposure is only at 15%. This is relatively low compared to, say, the S&P 500 at around 30%, and U.S. is only a fraction of that. At the same time that the U.S. is lowering their dependence on Chinese exports, China has also lowered their dependence on U.S. exports as well. We're seeing increasing export share to emerging markets and the global south as well.
What about this TikTok ban?
Yeah.
Will they, won't they?
Yeah.
Yeah. The impact for China, we've who knows what's going to happen this weekend, right? But, we've seen a handful of small A-share stocks related to the Xiaohongshu, and, they've been trading limit up for over the past 3 days. More broadly, we think that this TikTok issue is big enough that, it could potentially play a role in negotiations between the U.S. and China on trade or tech issues once Trump takes office.
That's Bloomberg Intelligence equity and strategy analyst Marvin Chen there. Now, some corporate headlines we're following this morning. SpaceX has lost its Starship rocket during its 7th test flight, an unexpected setback after earlier making steady progress. Despite the loss, SpaceX successfully caught the rocket's super heavy lower portion in mid-air using giant mechanical arms. The cause of the loss is unknown, and the company will go through flight data to determine what went wrong. Nintendo announced that the much-awaited next-generation Switch console would be revealed in April. The new model, called the Switch 2, looks similar in concept and design to the current console. The Japanese video game maker also confirmed the new model will have backwards compatibility with original Switch games. Nintendo is aiming to sell over 20 million units in its first year.
Yeah. I know a few people who'll be part of that 20 million. All right, let's talk about this other potential deal. And it's playing out across these markets. So Rio Tinto was down as much, I believe, over even closer to 2% at one point. As you can see, we're almost completely retraced back. Now, sources say that, well, the company has been discussing a merger with Glencore. Paul Allen is with us right now out of Sydney to talk us through. Paul, yeah, what do we know about these merger talks?
Yeah, well, let's get this out of the way right away. This is according to sources, people familiar with the matter who can't be identified because obviously all of this is confidential and very sensitive as well. And it's not even clear if the and Glencore and Rio Tinto are really not doing anything to clear up the confusion either. There's been no official comment from either company so far. But if it is correct, this would be the mining deal to rule them all. It would be huge. Rio's got a market cap of over 100 billion. Glencore is somewhere in the region of 55 billion. Put them together and suddenly you have an entity that is bigger than the world's biggest miner, BHP. There are some obvious synergies here as well. There are also parts of the business that perhaps wouldn't work so well together. But where these two would work well together is in terms of copper. Copper is, of course, on the upswing as the world moves towards decarbonisation efforts. We saw in Rio Tinto's third quarter production results yesterday that while iron ore production declined, copper was up 26%. Both Rio and Glencore have got quality copper mines all over the world, and if you put them together, they will control 7% of the global supply.
Paul, it's Rebecca here. Tell us, what are analysts saying about the merits of this possible deal?
Yeah, analysts and the markets both unconvinced about the merits of this. Bloomberg Intelligence had some early reaction, noting that the deal did look to favour Glencore more than Rio, should it proceed, of course. Bloomberg Intelligence noting that Glencore production is stagnant, Rio Tinto's production, meanwhile, among the world leaders as well. And apart from scale and diversification, the merits for this tie-up for Rio are not so obvious. RBC Capital Markets was out with some analysis that really echoed that as well, saying the motivation for Rio, not really obvious here, but for Glencore, might provide an exit strategy for some shareholders. Goldman Sachs, meanwhile, has cut its price target for Rio by 1% on the news. There's another sort of issue here as well, and that is coal. Rio Tinto's exited its coal assets, but Glencore still has significant coal assets. So if this tie-up were to proceed, there'd be a huge question mark over that as well. And that's before we even start discussing company culture, regulation, and whether shareholders even want this. And as you can see, Rio shares are currently a little bit softer here in Australia.
That was Bloomberg's Paul Allen in Sydney for us. Now, up next, Qatar Airways cargo chief Mark Drusch joins us for his industry outlook for the year and the impact of any potential Trump tariffs on air freight rates. Stay with us. We'll take a quick check at markets.
Yep, plenty more ahead here as we wrap up, finally, a trading week where stocks are largely in the green on a weekly basis. But as you can see today in the first 10 minutes of trade, we are looking at a little bit of pressure across these markets. We are in a holding pattern ahead of the release of some key numbers coming through at the top of the next hour. Stay with us. You're watching The China Show. Happy Friday morning to you. Right, good morning. Welcome back to the show. You're watching, clearly, The China Show. Lots to get through here as we, I guess, try and map out what this 2025, what this looks like market-wise for the economy. There's a big question mark over tariffs, and you look at how markets and the dollar has traded. You look at some of the data that's come through out of the trade numbers. You look at Taiwan, Korea, Hong Kong. Within those numbers, you do see idiosyncratic surges in trade between it. Might that indicate front-loading? You look at the PMI numbers out of China also indicating as much. Let's get a sense of what it really is looking like from a corporate level and from an industry level. Joining us here to talk us through the air freight outlook for the year is our transport reporter Danny Lee and Mark Drusch, Chief Cargo Officer at Qatar Airways Cargo, one of the world's largest air cargo carriers. Danny, let me start with you. Why don't you set the stage for us?
Yeah, we're heading into a new U.S. presidency, and there's a lot of talk about tariffs and the potential reshaping of the global trade here. So, Mark, talk to us about what you're seeing in terms of the global airline industry and for the implications for global air rates.
Certainly. First of all, good morning. Thank you for having me here. Let me set the stage properly, though. At Qatar Airways Cargo, we don't participate that much in the Asia-U.S. market because of our geographic location. Yeah. We're based in Doha. You know, we're focused on the trade between Europe, the subcontinent, Asia primarily, and Africa. So our participation is very limited. However, when it comes to the tariffs, we have to understand nobody really knows what it's going to be. In fact, you've seen over the last couple of days, even the incoming administration's people are saying that they're still evolving their thinking on what the tariffs will be and how they will apply them and whether or not they will be on a sequential basis depending on progress. So from my perspective, I think we are overly concerned at this point in time because we really don't know where it's going to go.
What assumptions are you making then, overall?
For the year. Global economy.
Plan your business.
Here are the assumptions we continue to hold to. We assume that the Chinese export economy will continue to grow. We assume that Southeast Asia will continue to grow, particularly Vietnam and even Cambodia. The Indian economy, as long as the GDP continues to grow at a 5.5%, 6.5% rate, we expect that growth to be significant, both inbound into India as well as outbound into India. We've seen on the transatlantic, which we participate a little bit in, we've seen that's tightened up a little bit. I mean, it's got a little bit stronger, I apologize. So we expect that to grow. So overall, we're optimistic about growth for this coming year. The GCC economy is still very strong. There continues to be significant growth in those economies. So from we are positioned, we expect there to be a good year this year.
Yeah, there are a lot of opportunities out there, and there's a lot of questions still for what it means for the global trade links. I mean, what are the kind of conversations that you're having with clients, with other industry players about what potentially Trump and what other kind of factors in the global economy means for how routes will evolve?
Well, let's be really clear. One of the biggest drivers this year, or the prior year, has been the growth in e-commerce. And everybody I just was in Guangzhou, all of the e-commerce players expect there to be continued growth in e-commerce. We've all become so accustomed to buying things online, expecting them very quickly. We don't expect that to slow down, and neither do our partners in that business. That's number one. Number two, we expect things like semiconductors to continue to grow. Our lives continue to become more dependent on technology, which drives the need for semiconductors. And furthermore, we expect, as I said, in India, the continued growth of just consumer products in the big economies.
Well, give us a glimpse of what those three sort of major components look like, because we started out by asking you what the assumptions are for this year. In some ways, I can look at your data and I can get insights into how the other stuff is doing. Yeah. So tell us how last 3 months, data on India, tell us about semiconductors, and also tell us about e-commerce.
Yeah, so just to give you a little background, last year e-commerce grew for us almost 25%.
Wow, okay.
Massive growth, massive growth. Our India demand grew about 15%, both inbound and outbound. Again, very strong growth. So we expect those to continue, not necessarily at that same rate, particularly for e-commerce.
Still double digits, though?
Pardon me?
Still double digits is your expectation?
Absolutely. I expect it to be double. Now, this is all dependent, of course, on base GDP. Okay. If for some reason the major European economies' GDPs continue to shrink, we should see some decline in that growth. You guys saw the German GDP last year actually shrunk marginally.
Yeah.
Right. We know the UK has had a couple of quarters of marginal reduction in their GDP growth. So if the GDP growth in Europe continues to or accelerates the shrinkage, that will obviously impact it. But at the same time, we are able to offset that by the growth in economies like Southeast Asian economies and India. So our role is to understand where the markets are moving and be present there. As markets strengthen, we need to put more capacity in there. If markets weaken, we redeploy the capacity.
With growth then, what are we seeing in terms of yields for the global aviation industry? Are you able to see growth, and is that going to translate into higher yields?
You know, it's a very competitive business. It's competitive for two reasons. Number one, you've got freighters like we operate. We operate 28 freighters. You also have the bellies on the passenger aircraft, which also carry a significant amount of cargo. So that the supply-demand equation is, or pricing, as you know, Econ 101, is based on your supply and demand. So if the demand is exceeding the supply that's going in, we should expect pricing to go up. If it's on par, pricing will stay the same, and obviously if demand goes down and capacity continues to grow, we should see it come down. So it's a long way of saying it's Econ 101. It changes every day based on demand and capacity.
The pricing is favorable at the moment?
Well, it all depends who you are asking what favorable is,
well,
right?
We're asking you.
Yeah. From an airline perspective, the pricing has been very good because, again, the markets have been very strong.
I think during the break, you mentioned that some of the growth this year will depend on deliveries, for example. And I'm wondering, is capacity holding growth back?
Yeah. It truly is. Capacity is holding growth back. As we all know, both of the major aircraft manufacturers have had challenges in delivering their aircraft, and that affects all of us, both on the passenger side and on the freight side. And as I mentioned before, a large portion of our freight is carried in bellies. So when you see both passenger aircraft deliveries and freighter deliveries being a little bit delayed, that puts a constraint on the overall supply for the global cargo industry.
Yeah, and here in Hong Kong, you operate quite a sizable operation, up to 7 flights a day, multiple flights a week. Going forward, how is that going to be for Qatar Airways Cargo? Are you going to be planning to operate more flights, more expansion? Is that in the pipeline?
There are two things that control how much we add. Number one is demand, but number two is regulatory conditions. We were very fortunate last year in that we were able to increase our capacity by 20% in Hong Kong, 25% in Hong Kong, because the regulators allowed us to operate more. We would hope with the third runway here in Hong Kong, the regulators will continue to see the need to bring in more capacity to help pay for those bonds for that third runway.
Yeah. Anything else we're missing for this year?
Fuel prices.
Okay.
Of course, fuel affects our costs. Fuel has gone up, as you know, recently, last couple of weeks, a little bit. Still not out of control. If for some reason fuel prices go up dramatically, that also will affect not only pricing but capacity.
And do you get a sense that you can pass it on in case it does?
There's only so much you can pass on.
Okay.
People forget, again, Econ 101, pricing is not driven by your costs, it's driven by supply and demand. So there will always be a point where if your prices get too high, you will kill your production because it'll be too expensive.
Mark, we could be here for much longer, lots more to talk about. Let's do this again next time you're in town.
Absolutely, would love to. Thank you for having me this morning.
Thank you for coming in. Mark Drusch there, Chief Officer Cargo at Qatar Airways Cargo. A lot of cargoes there. Danny Lee, of course, here with us on set as well to take us through, of course, his thinking. Our transport reporter here. Okay, something to tell you about. Oh, the story keeps giving. We're looking at this Vanke story, not just the stock, but the bond is also in focus, Rebecca.
Yeah, onshore bond halted here after this big price plunge. I mean, not necessarily a huge surprise. We saw a little bit of this coming through earlier this week. You think about the dollar bonds, you can see they're already pricing in quite a high risk of default here. We have some of the 2027s I'm seeing on my screen, somewhere in that 30 cent on the dollar range. Ooh. It tells you about the kind of risk that we are looking at so far.
Yeah, it's priced for imperfection. Happy Friday. Well, let's see how this story goes. We'll get you a preview of the China data coming up next. This is the China Show. Okay, we have a couple of minutes to, I guess, to recap the data that's come through this hour and preview what's coming out in a few minutes. The property prices, new, that's separate set, and existing separate set. 70 cities, month on month, you're looking at new homes. Some green shoots emerging, falling by the least in about a year. Still falling, but arguably you are seeing a recovery here, Rebecca.
Yeah, and this is actually quite a significant and important shift because we essentially have been waiting to see, not necessarily just if we get into that positive territory, but if we see this slow down a little bit, a decline in the pace of these falling sales. Of course, the property market has been so beleaguered. We have seen so many efforts to try and boost Chinese property, not least this effort by the government to have authorities buying up some of this loose excess of supply.
Absolutely. I mean, it is a multi-pronged attack to really a problem that is still, I think, early green shoots, as we were talking about there, but certainly still widespread. The chart we just showed you there is still, the vast majority of the cities surveyed do still show some declines year on year, which will take some time. We'll leave you with a live look at Beijing, and we are waiting, of course, for the press briefing to begin just as the data drops in about 5 minutes from now, so stay tuned for that. And also coming through as well here on the China Show, Helen Qiao will be joining us, of course, to take us through her thinking here on the data coming through.
Welcome back to the China Show. It's a big day for China data. That's really where markets are focused. Here's a look at the CSI 300 about half an hour into the session. Things just down a touch as traders digesting the news that is about to come. Of course, we're expecting the quarterly GDP numbers, among other things, as well as that big annual number. The questions of whether or not we've seen the economy start to rebalance, whether or not some of that stimulus is actually starting to take effect, Dave.
Yeah, I mean, we have, I guess, seen some signs of that. I think few and far between, at least, we have seen things pick up, but certainly on a broad aggregate basis, definitely not. And I think when you look at the credit numbers that have come through so far, certainly demand for credit is still wanting. The numbers are just breaking right now. We are looking, okay, what do we start with? Let's start with the 4Q GDP print. 5.4%, above estimates of 5%. The full year coming in at 5%. Estimate was for 4.9%. Rebecca, what else are you seeing?
Yeah, interesting there. So beat on both those fronts, and quite a comfortable beat on some of that. Industrial output rising as well. That is beating estimates again. That's up 6.2%. And it might be, though, this retail sale rise, slight beat. Estimate was 3.6. It came in at 3.7. But people are really looking at that retail number to that point about rebalancing the economy, whether or not we are seeing the Chinese consumer coming back. A very marginal beat there.
Yeah, I'd even go as far as saying on most, if not all, of the headline numbers, that's actually a beat almost across the board, if not across the board. I mean, with the exception of property investment year to date, which I think we can set aside just because that's a sort of separate data point. But yeah, activity numbers coming through, all coming in, including the GDP print, just above estimates here. The quarterly beat, I believe, is the biggest gap to the median estimate in about a year and a half. So that's also, to your point, quite a sizable gap there, Rebecca.
Yeah, really interesting to see such a robust number coming in through there on that absolute. You know, I think people were actually quite sanguine coming into this, particularly, of course, we've been days away from the Trump administration. So I think that's sort of been, you know, at least a psychological overhang for these markets, trying to sort of figure out and, of course, front load what some of those potential tariffs are going to mean.
And what that means for policy and the offset. And I would imagine they themselves are waiting for what Trump first does, and then they'll respond to that. Why don't we get a sense of instant reaction as we wait for more details coming through and commentary from the National Bureau of Statistics on your screens. Joining us here on set in Hong Kong is Helen Qiao, Chief Greater China Economist at BoFA Global Research. Good morning and nice to see you. not sure if you heard the numbers, just your reaction to that? Yeah?
Yeah. The GDP numbers look pretty awesome. I think that's 5.4% for the fourth quarter. That's definitely a beat. And that probably came as a combination of two things in our view. Number one is that I think, manufacturing-wise, I think industrial activities probably held up reasonably well. We kind of knew that after seeing 3 months of PMI, staying above 50%. So that implies a sequential improvement continuously. And there was some hope that actually after the policy package was delivered on September 24th, there could be some turnaround in the data. So I think that's, on the industrial side, which is very much helped also by the front-loaded export orders. So that, I think, clearly helped. And secondly, I think from a service perspective, we also saw some turnaround as well. And activities were, actually holding up reasonably well towards the end of the year. And from a, let's say by expenditure perspective, consumption-wise, the subsidies from the government, especially on home appliances, clearly kicked in with its impact. So I would say that generally speaking, this is definitely a very good score for the whole year of 5.0%. So completely in the center, of that target range. And therefore, that's very good news. But so far, I haven't heard anything about the fixed asset investment, which would probably be interesting to watch as well.
Actually, we have that. Yeah. Let me give you a sense of that. And we were remiss of our duty not to mention that with the flurry of numbers that's come through. Thank you for the reminder. Fixed asset investment year to date, so 3.2%. How does that sound?
That's
slightly below.
That's a slight miss, yeah.
That's a slight miss.
So because we thought that a year to date they can do at least a 3.3, that will leave the single months at about 3%. So if they actually shot slightly under that, that probably implies on a single month basis, we probably see year on year in December fixed asset investment somewhere slightly below 3.
Okay.
Yeah.
I just want to pick up on your point about the white goods, the home appliances, some of those consumption-led efforts, and what your outlook is for 2025 when it comes to deflation. Of course, we've seen this very long streak, possibly entering the longest streak since the Mao era, essentially. What are you expecting for 2025?
We think CPI inflation is probably going to hold out and remain above 0 this year. So we will not have outright kind of deflation with negative CPI inflation reading for the whole year. But that said, we think that in sequential terms, we probably need to see, the aggregate demand turning better and therefore pushing the prices up a little bit further. So far, I would say that up until about the end of last year, it is still disappointing. I would say that we would expect that the sequential CPI inflation to go back towards 1%, maybe by about the end of second quarter. And so far, we haven't seen that, but we're optimistic that it could potentially happen. But with that said, I would say that the help from the government is not going to be, interrupted because of the new year. In fact, from the press conference last week, they were talking about that they are going to front load, 81 billion renminbi, basically, dedicated for the consumer product trading program. Yeah. And therefore, that implies, in our view, probably for the whole year, we're talking about the whole kind of 2 new program, which is the trading programs for consumers and also equipment upgrades, going from last year's 300 billion to about 600 billion at least this year. So that's a doubling of the effort from last year, and therefore we think that could be implying pretty good policy catalysts going forward.
Is that doubling, and are these policy catalysts, are they going to be able to mobilize the Chinese consumer sufficiently to offset potential tariff shocks?
Great question, Rebecca. I think that's the jury is still out, and that's a very hard question in the sense that I think that this is a neatly designed policy stimulus in the sense that, okay, if you are going to front load your purchase decision and buy a rice cooker and buy an air con, well, now up to 3 air cons, and then we're going to, basically subsidize that with up to 20% of the total bill. But I would say the problem for overall consumption momentum still goes back to the consumer confidence. So they would need to find a way to more sustainably boost the consumption by boosting consumer confidence. How exactly can we get that done, right? How can we change people's expectation? Some people say, well, it's because property prices are dropping and therefore wealth effect, right? Negative wealth effect and make people very unlikely to spend. Actually, that is very muted. That impact is very muted in China. And also, how about cutting the rates so that if interest rates go down, people can borrow more to spend? Chinese do not actually spend on borrowing money that much. So the most important thing in our view actually goes back to their income and income expectation. They need to be more secure about their jobs, and they need to have positive expectations about the income stream going up, right? On a positive trajectory. So that I think would be key, which goes back to the overall theme that we need to see overall demand getting better. And when this is still insufficient, the government has to come in and probably give a very strong boost to the overall demand, especially if, let's say, we were potentially going to see the shocks from tariffs.
That's a good point. And I want to ask you then what your current assessment is of the labor market. And I think that also goes into, we've seen so much pronouncements around sort of the government to central government to local government, central government to local government to consumers. What we have yet to see is really something that is targeting to the private sector, which does most of the hiring. Just your sense of how that story plays out this year.
Well, great question, Dave. After 2-3 years of a pretty challenging labor market situation, while we do not necessarily see too much of that in the urban unemployment rate reading, it still holds up at about 5.2, 5.3. We haven't seen the numbers for today, but I would assume it's probably still in that vicinity.
5.1.
Oh, see, slightly better. So even that is the case, the challenge is that for those college graduates, they still struggle to find high-paying jobs and the jobs that will actually give them a positive trajectory going forward. So that is the potential, challenge that we see as the most important from the past 2-3 years. It actually came all the way from COVID time, when it was difficult for people to predict the future and for companies to commit to hiring people, and that goes all the way over here. A lot of the students actually chose to go to graduate school and postpone that, but they are graduating anyway. Are you going to send them to do PhDs, all of them? Right. So we are about to see more of the such 30 million college graduates in the past 2-3 years, kind of gradually being released more to the market. So we think that this year the government will probably need to do a bit more to also support that from a social welfare perspective, to probably lower the burden of the social welfare payout for companies that hired new graduates. And for example, by training the new graduates so that they can better find a job and potentially stay on that job, on those jobs. So those, I think, would be the efforts that they do on the labor market end. But ultimately, it comes back to the fact that we need to see better aggregate demand. So, policy communication will be key. If there's going to be a major package that will lift everybody's expectation, I think they tried to do that in September, and the steam is a little bit lost by now. So maybe there will be time by about March or April that they need to do more.
There is a void to be plugged. Let's leave it there for the current segment. More, of course, with Helen Qiao and her thoughts on how the story evolves moving forward. You can also turn, by the way, to your Bloomberg terminal for our clients, TLI Vigo, the ongoing blog here, and context analysis and some hot takes, of course, and the numbers which did come in mostly above expectations. Plenty more ahead. This is Bloomberg.
China's National Bureau of Statistics currently holding that press conference this year for the GDP numbers that have come in. A pretty comprehensive beat there that you can see on your screen. The fourth quarter GDP, of course, coming well above that estimated, actually at 5.4. Even that annual GDP expectation was, we saw at 4.8, 4.9. came in really at 5%. Even retail sales, where there was some anxiety about whether or not we would see that number reach the estimate, that coming in just over there. We are back here still with Helen Qiao, Chief of Greater China Economist at BoFA Global Research, here breaking down the very latest numbers. I want to just pull out this real estate number that has come through. It looks like we're almost at zero, essentially, so the slowing of falling prices. Tell us whether or not we're starting to see any green shoots coming through. Do you think that we will see a bottoming out in, say, the first quarter of 2025?
Rebecca, first quarter is a little bit ambitious. Okay. I would say potentially maybe a third or fourth quarter this year. We're still the more optimistic bunch out there compared to our competitors when we talk about second half this year instead of 2026. So far, I would say that the property market has been helped by the policy easing that we saw in September, October, as we could see that the secondary market volume, sales volume held up reasonably well. At the same time, the new home sales also improved. So that was definitely something in the fourth quarter that where things seems to be suggesting that is stabilizing. But on top of all these, retail end, or let's say, at the very, home buyer kind of level of information, we also see something better from the upstream, which is we saw that developers, not only SOE developers, but also private developers that are starting to come back into the land market and start bidding. And we are seeing them being largely on hold for about 9 months or so for the entire 3 quarters from Q1 to Q3. But in Q4, they're starting to come back and buy land. So that, I think, is a very positive tone, because if they keep not buying land, we probably would not have too much sales going forward anyway. So now with the pipeline in place, with the land already in their pockets, they probably need to start to develop in another, let's say, 3 to 4 months, because that usually takes about 6 months time for the development to take place. So that, I think, is definitely good news. And not to mention that price-wise, if you look at the tier 1 cities, Shenzhen is starting to show some more positive signs before the end of the year. And then it move on to Shanghai. So we are seeing a little bit of more positive dynamics, moving from tier 1 to tier 1. Not yet seeping through to tier 2 and tier 3 and below. But we think this is usually where the positivity would start. And that is the right order of, or the right sequence of events we were looking for.
Yeah, things, as you know, tend to move very quickly once that bowl gets rolling and snowballs really in China. And I think the other thing you alluded to there, interesting, because since they're tapping the land markets right now, that's also revenue for the local governments too.
Yes, absolutely. It's still low compared to 2019, 2020 levels, but definitely this is the beginning of something looking better. Obviously, we need to see whether the private or semi-private developers on the market will remain pretty resilient and hopefully not to default outrightly, and therefore we could continue to see this momentum being built so that people would get more confidence in the property market by buying more land.
On the tariff front, and I think we've had these conversations previously as well, I mean, Donald Trump's coming in. What do you think officials have in their back pocket to respond to tariffs?
Well, we think that there will be a whole mix of policies probably from China's end to think about what will come and how we're going to respond. And first and foremost, if there is additional tariffs being hiked from the current level, from the U.S. current level of imposed on Chinese goods, from 20% or so prevalent, which is prevalent now, and maybe they will potentially hike it to 30%. We are expecting a gradual increase by 10 percentage points by about second quarter this year. So if that takes place, we think China will probably, first and foremost, come up with a list that they are going to raise the tariffs on the U.S. imports. That is a must-do. China won't be able to reap as much tariffs as the U.S. imposes on China, because China naturally buys much less from the U.S. But I think that's something that they first of all need to make announcement of. And on top of that, they probably would combine with some of the other other measures, such as allowing renminbi to depreciate maybe a little bit faster to offset the pain from this particular tariff shock. And at the same time, maybe there would be some other suggestions for negotiations. I think if the U.S. and China could potentially sit down and negotiate, one possible outcome is that maybe this tariff doesn't have to stay there for much longer. In fact, China could promise to buy more. The deal that they made back in 2020 wasn't properly delivered because of COVID. But this time around, China still has the capacity to buy, especially energy products from the U.S. So maybe more oil and gas deals.
Helen Qiao, we could talk to you all day. Thank you so much for joining us. That's Helen Qiao, Chief Greater China Economist at BoFA Global Research there. We'll be looking at these numbers, staying on them, a bit more analysis coming through too. Stay with us, there's plenty more ahead. This is Bloomberg. Welcome back. You're watching The China Show. Now, Rakuten Group says investor confidence is growing as the company works to diversify its funding. This comes after years of losses and a stretched balance sheet. In an exclusive interview, Asia Trade's co-anchor, Sherry An, asked CEO Hiroshi Mikitani if he expects the Japanese conglomerate's mobile business to break even this year.
Of course, we're going to break even. It depends on how you measure it. In terms of pre-marketing cash flow, we are already profitable. And the benefit we are giving to our ecosystem services, such as shopping, travel, card, banking, brokerage, it's huge. So it's not just about standalone business. It's about how we can enrich our ecosystem and improve even our customer engagement more. So we know that if they join Rakuten Mobile, they buy almost 50% more from our marketplace. They use credit card 40% more. Sometimes they travel a lot more. They use 2.5 times more new services from Rakuten ecosystem. So it's kind of our anchor subscription service in a sense.
How successful have you been in trying to convince investors in the markets on that message of building the ecosystem? Because there's been a lot of chatter about, can the mobile business turn around?
Well, if you think about total enterprise value of the company, of course, to do this project, we took a lot of debt. But if you think about enterprise value, equity plus debt, our enterprise value went up so much, right? So if you think of just pure the equity value, it went up, but not so significantly, but which will come, I think, because we're going to start basically replacing our debt with our retained earnings.
Which you're already starting to do, perhaps in a way raising funds as well by the sale of a stake in your card business to Mizuho as well. Could you see more of that?
Well, it's just, obviously we do not want to just sell important asset of us, but if there's a synergy which we can make, or if you can use, bringing the company to public, we can further accelerate growth, we may consider it. But with an internal cash flow, I think we are very, very confident that we will be able to, repay debt to the certain level. I don't know whether it's debt-free is the right strategy or not, but I think we would like to take off some of the debt burden and make it our balance sheet even more healthier.
And we're seeing that investor confidence on Rakuten also improve recently. Yes. Does that mean that perhaps you could be confident to tap the Japanese markets, yen bonds? Could that be a possibility?
Yeah, of course. Our yield of our bond came down significantly. That means the bond investors are very, very confident, or building their confidence in our business. And with a further performance we prove, then I think definitely we will be able to bring down our sort of interest burden further, I think.
Why not IPO? Wouldn't that be a good source of cash as well?
Well, again, maybe we're going to do IPO for the credit card too in the future.
Is there a timeline?
No pipeline. Obviously, there's a pros and cons for bringing the company to public. But we proved that Rakuten Bank is making unbelievable growth in terms of accounts and also scale of the business and also the profitability is unbelievable. It is going way beyond our original plan. And it is partially coming from the fact that we gather the equity from the public market. So we have a lot more equity cushion to grow our asset.
And if you needed more cash flow as well and liquidity, could you be selling more to Mizuho?
We don't have to now. I don't think. Yeah. Of course, it's. I think the company is still can become more valuable. So unless there is a very, very strong financial sort of necessity, we would like to keep as much part as possible. But having said that, if there is any sort of emergency, just for the investors, we have the safety option to monetize some of the asset and repay the debt.
And we'll have plenty more ahead. This is Bloomberg.
Welcome back. We are going to live pictures from Beijing, where China's National Bureau of Statistics is holding a briefing. We, of course, have had this barrage of numbers. We've been waiting for this to see the quarterly number, and really quite a robust beat when it comes to that fourth quarter. We saw it exceeding estimates there, as well as a slight beat for the overall annual GDP that came in at about 5%. We've also seen, interestingly, factory output, retail sales coming in over expectations. That retail number is one that traders have been looking at quite closely to try and understand whether or not some of the effects of this stimulus is coming through. Of course, the big question, whether or not we can see the economy being rebalanced going into 2025, trying to offset some of that impact for these potential trade tariffs as we have the incoming Trump presidency. Let's bring in Bloomberg MLive strategist Mark Cranfield in Singapore to help break down. Mark, just simply, what are investors making of these numbers?
On the surface, I mean, it's a pretty decent bunch of numbers, particularly the GDP and the industrial production. They beat forecasts, as you were saying there. But of course, the big issue is where do we go from here once Donald Trump becomes president of the United States, and there may be some tariff occurrences between the United States and China. And then, of course, it's the continuation of the stimulus policies from the Chinese side, especially in relation to what the PBOC, the central bank, is having to do as well. So investors really are very keen to see a lot more, particularly in terms of lowering interest rates. There's been plenty of liquidity pumped into Chinese money markets, but they've been stalling on the interest rate cut side, which traders want to see, investors want to see that as well. And that's partly because the bond yields fell so quickly and they're trying to stabilize the bond market. So that the Chinese authorities are really trying to do so many things, and in a way, it's hampering what happens to Chinese assets. So they're trying to stabilize the bond market, stabilize the currency, and at the same time trying to provide support for the equity market as well. It's a pretty difficult juggling act until you have a sustained bunch of economic data coming through, which is starting to happen, but still needs to have a lot more. And of course, we need some more clarity on exactly to what extent China will be hit by any potential new tariffs coming out of the United States.
Yeah, Mark, and I think the point you're just making there, that, you have these almost regular cadence of periodic voids that authorities need to fill in, right? And I think we've seen that in the form of a briefing here and there. The reason I bring that up is there's been a lot of speculation in markets that short term we could see the PBOC deliver a triple R cut, maybe going into this weekend, maybe ahead of the Chinese New Year. Mark, your thoughts on what that could do as far as helping short-term sentiment even further?
It certainly is a positive if the PBOC does lower interest rates of any kind, whether it's the minimum lending rate or the triple R, whichever one they pull on, markets will certainly be happy about it. The timing of it will probably have a lot to do with what we hear next week. Once Trump is in the hot seat, we'll probably get some initial messages coming out from him, see how Chinese markets react to that. They still have a small window between the inauguration and the start of the Lunar New Year holidays. So the PBOC could certainly operate within that time. Obviously, first of all, they want to look very closely at what happens to the currency, because before they step on the levers of easing any interest rates, they'll want to see how foreign exchange traders react in the market. For now, the yuan's been pretty stable for a few days, but it just feels as though it's on the verge of wanting to do something. And it's clearly the narrative here is that dollar yuan will probably have to go higher over the next few months to offset what could happen to Chinese trade position. Well, that may well start next week. And if the yuan is moving too quickly in the offshore market, they can control the onshore much better. But if there's a lot of speculation going on in the offshore market, then the Chinese authorities may want to dial back a bit. So it's very much a case-by-case, day-by-day situation. We'll get a much better picture next week.
Mark, just your thoughts going into the weekend on the S&P 500, maybe broadly U.S. equities, which I'm just looking at sort of weekly prices here. I mean, it seems like we're still stuck in this consolidation phase. We still can't manage to really meaningfully break first the 6,000 level, and every time you put together two good days, you get a really bad day in U.S. equity markets. What do you think is going on currently?
Well, we're just starting the earnings season. The banks have got off to a good start, but what everyone really wants to see is the big tech companies. There's really so much dependent upon what the major companies such as Microsoft, Apple, Alphabet, what they produce, and of course NVIDIA at the end of February. So if you look at their share prices, they've also been going a bit sideways, or some in NVIDIA has actually been sliding a bit. So really, you can tell that the stocks which are most widely held, the great big ones contributing to so much of the move last year was just down to a handful of stocks. Now, if they can't produce good earnings, then the equity market could be in a bit of trouble here, because the Fed is already saying that they want to go on hold for some time. So you're not going to get the stimulus that we had last year from lowering interest rates. So it really comes down to the earnings and the outlook. So that's going to be more important than ever. So this earnings season, particularly for the tech space, is a very big one.
Mark, fantastic. Thank you. Mark Cranfield in Singapore for us, a market context as we go into the thick of the Friday session globally. Right, some movers to tell you about. One stock, of course, in particular, we're tracking here in Greater China, and the story is really the whereabouts of the CEO. The stock is down 7.2%. This is the Hong Kong listing. The other ones in focus, Rio Tinto, on the back of that report, possible, or they're looking at talks with Glencore for a potential merger, though you do see, in terms of context, lots of hurdles before that can actually come to fruition. Nintendo going into the Japanese lunch break, offloads of the day, April 2, Switch 2, and TSMC, which had a massive day, by the way, to the upside on Thursday, currently flat right now, reversing some of the early gains right now, following the company's outlook, which really beat estimates. In fact, it's after the profit there for December, 57% for the company. You have this AI spending cycle continuing to provide tailwinds. The role, of course, as the main chip maker for Apple and NVIDIA. That's the proxy for those trades. Stephen Tang is with us here on Sets, senior equity analyst, to talk us through these TSMC numbers. And what do you make of that? Their view on capex in particular, Stephen?
I think obviously that's a big surprise. I think the street is kind of looking at anywhere between 15 to 20% previously, but now obviously we're looking at over 30%. And that kind of underpins the management's confidence on the whole AI demand. If you look at what happened recently, the news flow, they're concerned about the demand outlook. They're concerned about certain order cuts in the TSMC's CoWoS capacity, but now obviously both NVIDIA and TSMC came forward and denying that there's no such thing. Everything is on schedule. And if you look at TSMC's execution, it's still very solid. The overseas expansion, the capacity has been ramping up the schedule, and the production yield in the Arizona fab is basically equivalent to what happened in Taiwan. So all things are pretty impressive. But then, of course, you have to have the concern for this geopolitical situation. The U.S. just has sort of renewed a curb on all the advanced chips. Potentially, that's another restriction on those chips available to China. And so obviously that becomes a sort of ongoing challenge or uncertainty for a company like TSMC.
Just on that geopolitical issue, the landscape is obviously changing very quickly. We are counting down the hours, not the days, to Trump coming and taking office for a second term. Tell us, is geopolitics the biggest challenge for TSMC? If it's not, what is?
It's certainly one of the challenges for obvious reason, because now the way they hedge this risk is that they need to diversify their capacity set up, particularly having this new fabs in the U.S. Even though the yield is equivalent to the parent company operation in Taiwan, but the problem is, of course, the cost. The cost is always much higher. And then at the moment, the impact is maybe limited, given that the operation contribution is still limited. But over time, that, again, there's another ongoing issue, right? And then another sort of more obvious mid to long-term issue is about the demand. I mean, right now, yes, the AI demand is strong, and but other than AI, a lot of other, say, consumer, smartphone, or PC demand, we haven't really seen sort of meaningful recovery. So that's something that we may need to, obviously, we'll continue to monitor that, but at this point, we just don't really see any sort of bright spot there.
That's Bloomberg Intelligence Senior Equity Analyst Stephen Tsang there. Now, coming up and sticking with this topic of the gyrations of US-China tensions, American content creators are flocking to the Chinese app RedNote, also known as Xiaohongshu, amid uncertainty about the future of TikTok in the US. We'll be looking at whether this is actually a sustainable trend. Stay with us, plenty more ahead. This is Bloomberg. Now, TikTok looks poised to win a reprieve from a US ban as Donald Trump's incoming administration promises to give its Chinese owner more time to divest. The Trump team has signaled it will keep TikTok from going dark, and Monday's White House transition effectively gives the president-elect control over whether a ban is enforced. Now, meanwhile, the US Supreme Court has signaled that it could rule on Friday, that's today, on whether to uphold the law seeking a ban on security grounds.
And our tech reporter, Annabelle Jewelers, in fact, has taken a closer look at this and really specifically what's at stake for the app's owners and also its community of creators. Have a look.
TikTok users may not be out of time just yet, with the app's fate now seemingly in the hands of the incoming Trump administration. Meanwhile, the Supreme Court has signalled it's likely to issue an opinion Friday after emphasising security concerns.
Congress is fine with the expression. They're not fine with a foreign adversary, as they've determined it is, gathering all this information about the 170 million people who use TikTok.
Anticipating a ban, TikTok refugees are already flocking to another platform, also Chinese-owned. Xiaohongshu, known in English as RedNote, raced to the top of the free download charts on Apple's US App Store, closely followed by Lemonade, that's also owned by ByteDance. It's a highly memeable trend.
It's been hilarious to watch the migration to RedNote. It's also stemming from a place of community in the sense of community organizing, which is amazing to see the way that TikTok has even brought us together.
Banning TikTok would have major economic consequences for the rapidly growing creator industry, which Goldman Sachs predicts could be valued at $480 billion by 2027.
People have built their entire livelihoods on TikTok. So small businesses up to celebrities, it really runs the gamut in the way it'll impact people.
An Oxford economics report found that advertising and marketing on TikTok by small and mid-sized US businesses generated almost $15 billion in revenue in 2023 across 12 sectors.
90% of people who see something on TikTok take an action.
While American users appear ready to befriend their Chinese counterparts on RedNote and Lemonade, it may be a short-lived romance.
If this popular social media app got shut down, the primary winner will be its US competitors, Google Ads and Meta and even Etsy.
TikTok could still be saved if ByteDance agrees to sell its US operations. Bloomberg's been told Beijing is considering ex-owner and high-profile Donald Trump supporter Elon Musk as a potential buyer. TikTok's other hope is Trump himself, who in December appeared to change his stance, having previously backed a ban.
I have a warm spot in my heart for TikTok because I won youth by 34 points. There are those that say that TikTok has something to do with it.
Reports also say he may issue an executive order to save the app once he's in office, or grant ByteDance an extension to divest it.
He wants to hold all the cards, not just the aces. So he wants this as leverage as he gets into negotiations with the Chinese government and others.
A complete ban could also impact relations between the Trump White House and Beijing.
It would have a chilling effect in both directions, right? Will this be a part of the bigger trade war? Yes, but to what extent, I don't know yet.
You have no idea how much I want to...
Geopolitics, free speech and big business. While the lawyers and politicians argue, it's a community of mainly young creators that's set to be left in the dark. Annabelle Drawlers, Bloomberg News.
A US-based marketing agency says millions of these American content creators are turning to Xiaohongshu, known in English as RedNote. Hennessy Digital estimates Android and Apple have both garnered about 1 million global downloads, each from January 13 to 15. The majority came from the US. Now, RedNote also climbed from 186th place to the first place on Google Play. And so-called TikTok refugees, swarming RedNote, has also become this hot topic on Chinese media and social platforms. It's been a trending topic on Weibo, for example, and there's also this positive commentary that we've seen coming out in Chinese and China's official news outlets. So, for example, we have the People's Daily saying it is better to say that they are, quote-unquote, global villagers rather than TikTok refugees. It is better to say that they have found a, quote, new home rather than that they are wandering.
Yeah, and interesting, really, the surge, because of the surge in popularity of Xiaohongshu, it might actually test the limit of Beijing's tolerance for unscripted interactions between suddenly this new group, these two groups coming together online. You have Chinese users and those from abroad. Some examples here that we've seen so far on the platform, and of course, partly anecdotal. This is a short, small sample size of so far what's been going on. In many ways representative of some of the themes here. So here's one newcomer asking for a warm welcome onto the app. On TikTok, she makes memes using her favorite TV shows and wants to keep that going in case the ban actually takes effect. Another American refugee who says it's warm and cozy on Xiaohongshu. The problem for him, though, is most of the content is in Chinese, so he can't understand any of it. Now, this user then goes at length to explain why being on a Chinese app is not a major issue. She argues that if Washington really cares about national security, then it would ban all Chinese apps, including the popular shopping platform Temu. So, yeah, this is certainly getting into conversations around, on one hand, its political stability to national security. In fact, I think the question got asked at the foreign ministry briefing in China yesterday, who describes people signing up to social media platforms as a personal choice.
Yeah. I mean, I think that question, in fact, that last new Xiaohongshu user asked is a prescient one, which is, if we're going to ban TikTok, why aren't we banning other Chinese social media apps? And that is indeed the anxiety here for Beijing and for China, that, essentially its global tech ambitions are going to be hampered by US-China tensions. I mean, that's actually really the fundamental question here, is to what extent is this sort of once free flow of information now going to start being severed and fractured?
I mean, is setting a fence up even feasible?
Yeah.
I think, and I think this really, I guess, in many ways shows you that while you can game out scenarios, it's very difficult to game out all scenarios and unintended consequences, including what we're seeing right now.
talking about those unintended consequences and how long what the People's Daily commentary calls as online ping-pong diplomacy is indeed even actually allowed to last, we have joining us Bloomberg opinion columnist Catherine Thorbecke. She thinks that this kind of cultural exchange isn't really going to be allowed to continue flourishing online for much longer. She joins us from Tokyo. Catherine, just tell us what comes next and why do you think that this whole phenomena is going to be so transient?
Right. So I think, as you guys have been talking about, there's something really sort of bizarre and also sort of beautiful happening on this app as, teens and young people from China and America sort of connect for the first time. But I think it's only a matter of time before political reality bites. Washington's concerns about TikTok are really only magnified on Xiaohongshu, on RedNote. And, TikTok at least had sort of a U.S. version, an international version versus the ByteDance's China Douyin version. And Xiaohongshu is just one platform. So I think it's, Washington's concerns don't go away here. And at the same time, I think that Beijing regulators, Chinese regulators, will also probably not be too happy with swaths of American youths coming on and influencing Chinese young people. We saw this with Clubhouse back in 2021, where there was, a brief flourishing moment of cultural exchange. And then very quickly, Chinese regulators came and shut that platform down when sort of conversations took a more political turn.
Yeah, well, I guess on the American side of the equation here, Catherine, is there anything either Silicon Valley or on the political side in Washington can learn from the rise of this particular app? How can we not find ourselves in this situation again, or is that even a feasible question to ask?
So I think that there's this misconception that these TikTok refugees are sort of cavalier or maybe don't care about these data privacy risks. But I think that these young people also grew up online, and they grew up in sort of a world where they feel like in order to participate in digital life, they have to give up swaths of their data to big tech companies, to advertisers, to authorities. And, there's been a number of scandals impacting U.S. tech companies. And I think that these TikTok refugees sort of recognize that their data is a currency for Silicon Valley. And I think this should really be a wake-up call for Silicon Valley and for Washington, that, it's very striking that all of these users are saying, we'd rather give our data to this supposed foreign adversary than to freely hand it over to, say, Elon Musk or Mark Zuckerberg. And I think for Washington, they should also sort of recognize that their sort of whack-a-mole regulatory approach so far is maybe not the right approach, and maybe it's time to try something different.
Bloomberg opinion columnist Catherine Thorbecke from Tokyo there on some of these paradoxical contradictions when it comes to US-China ties and what to expect going into the Trump presidency. Stay with us. There's plenty more ahead. This is Bloomberg.
Okay, let's take you through some of the movers across these Chinese markets right now. Duty-free, of course, CTG duty-free shares down. Earnings, prelim earnings missing expectations. They're down about 1%, not a lot really. We're looking at shares of Chinese real estate giant Vanke, A&H shares, Hong Kong and Shenzhen listing down, and as you can see, down substantially. We don't know where the CEO is, I think, is the questions around the whereabouts. One report suggests police had taken him away, although certainly the questions around what other possibilities are out there. And a not potential deal, actually, on the next board here very, very quickly. Zijin Mining taking a stake in a miner that's actually based out of, listed over in Shenzhen. The miner's up 10%. It's largely in potash, but this is a play really as far as lithium is concerned. Right, so we're looking at these markets, Rebecca. We're just fresh from the data. And of course, we're still waiting for maybe we get a triple R cut at some point. That's really the expectation to alleviate these liquidity concerns.
Will they? I've seen that speculation almost every single day in my trader chats, I have to say, for the last week. So will they, won't they? Who knows? We were expecting it to come in. But certainly this pretty robust, healthy set of GDP, I say that relatively speaking, healthy, is helping a little bit of a boost to sentiment today.
Yep, and here's an iteration of maybe liquidity concerns going into the week and why we might actually need a triple R cut. Could come, of course, before Chinese New Year. We'll leave you to look at this. Plenty more to watch out for, of course, as we journey into the weekend. Happy Friday from all of us here on The China Show.